Headwinds from geopolitical tensions and geoeconomic fragmentation, volatility in global financial markets, global economic slowdown, and uneven monsoon, however, pose risks to the outlook. Taking all these factors into consideration, real GDP growth for the current financial year, that is 2023-24, is projected at 6.5%, with Q2 at 6.5%, Q3 at 6%, and Q4 at 5.7%. The risks are evenly balanced. Real GDP growth for the first quarter of next financial year, that is 24-25, is projected at 6.6%. The protracted geopolitical turmoil, volatility in global financial markets, and growing geoeconomic fragmentations, however, pose risks to the outlook. Now, taking all these factors into consideration, real GDP growth for the current year, that is 2023-24, is projected at 7%, with the third quarter at 6.5% and the fourth quarter at 6%. Real GDP growth for next year, and we have provided the figures for the first three quarters of next year. So real GDP growth for the first quarter of 24-25 is projected at 6.7%, for Q2 at 6.5%, and Q3 at 6.4%. The risks are evenly balanced.
Hello and welcome to Tracking Trends with me, Nikunj Dalmia. The mood point today is that bulls are taking it slightly easy. Hurry to go back home. Maybe it's Friday. It's been a good week. It's been a great week. So the markets are taking it today easy, just taking a chill pill. That's the right word. Nifty has plunged to the lowest point of the day, but still above 20,500. And the broader market also are underperforming. Small and mid-cap stocks have taken a hit and largely led by pharma, autos. But private banks and IT stocks, they gain because that's where the large amount of money seems to be coming. So what are we debating? What are we deliberating? And what are we discussing on this edition of Tracking Trends? Well, what has changed for RBI to change their outlook on GDP? And what has not changed? And what has not changed in terms of inflation understanding? And that why Reserve Bank of India is still of the view that tightening is not off the table. Is India poised for a robust growth, and how will bond yields and currency move from here? So a bit of a macro, flavor to our today's discussion. And to take this discussion forward, I will be joined by Jayesh Mehta in moments from now. But before we do that, I just want to establish that the bond yields reversal, I think, is more like a global phenomenon. Now look at US bond yields. They are down in the last 1 month by about 50 bips. German bond yields are down by 50 bips. UK bond yields down by 30 bips, Japan about 8-9 bips, and India is down by just 2 bips, even though for India the interest rate base is 7.24. US bond yields has come down from 5 to 4.1. Germany has come down from 3%, closer to 3% to about 2.5, 2.2, and for UK also sub 4, above 4 has become sub 4. And Japan, nearly 0.8, about 1%, that has come down substantially. So why Indian yields not falling? And why global yields falling? And how should one read into today's RBI communication, even though the governor today was sounding slightly more hawkish than what everybody anticipated? Jayesh Mehta, Managing Director and Country Treasurer with Bank of America, joins us. Now, Jayesh, nice to have you. Thank you for joining us. You are looking at the frame slightly differently today. Maybe that's your camera angle. And is that the way how Reserve Bank of India looking at the at India? Upar se niche dekh rahe hain.
No. The problem is, that there was a desktop challenge. So that's why I'm calling up from the phone. So that's where the angle issue. So
that's my point. Even Reserve Bank of India is looking at the economy from a different angle, right? Or bond market is looking at a market from a different angle. Globally, bond yields have come down, but Indian bond yields are still at 7.25.
No, but I was just hearing you talking about all the world yields coming off. But let's not even forget that if you really look at last 3 years, right, what is our high and low, right? Our high and low has been what? 580 one touch, maybe 760 one touch. average we have been between 6.5, 6, 7.
I think we lost his audio. Like I said, bit of a camera angle issue. Okay, can we go to Kunal? Kunal, well, like a day off, right? Everybody's taking it easy. Jaldi ghar jao. Let's enjoy the first 4 days of joyride. Don't worry about today's market action.
Well, it's the Friday mood, Nikunj. Undoubtedly, I think the selling and the profit booking is just purely based on maybe this week being entirely or extremely good for the market. So I don't see any change of pattern, change of guard from the bulls as such. But yeah, I think the good part about the market so far today is even in the last half an hour of the selling getting a bit aggravated, you have a lot of banking names which are making a comeback. ICICI Bank is back at the day's high. You've seen good strength coming from HDFC Bank and even the likes of Axis Bank, etc. They are making a very good comeback on the intraday basis. So I believe that's probably a strong indication that there's profit booking or there's selling at one end of the market, but then there's a strong bit of buying in the other end, which is the private sector banks.
So buy the decline?
Not
or wait for further decline to buy?
Wait for further declines to buy. But for the private sector banks, I think it's a good time even to buy them on rises.
Okay, so if you missed the gap up, if you did not participate on Tuesday's follow-up, time to perhaps buy an ICICI Bank or Axis Bank now.
Yes. Okay. Add to that HDFC Bank.
Okay. Oh, Jayesh is also back with us. So Jayesh, you were mentioning the point that for world, the bond yield went from 1% to 4%. Or 1 to 5% for the US market. For us, the bond
to 5%.
Sorry, I mean actually sub 1% became 5. I mean if I count from the COVID low.
Correct. And now for us, it's like if you really look at our mean average for 3 years, it's been 6.5 to 7.25. Well, of course, low and high was 585 one touch and maybe 760 one touch. So from that perspective, we are more or less good. In fact, with the kind of supply, with the kind of policy rate right now which we have, which is even though repo rate has not been hiked, but its liquidity has been kept tight and almost hugging till last 2 months, except barring this week at 675, almost 0.25% higher than the repo rate, right? So from that perspective, we are okay. I think we will see some buying coming in January onwards for the index, but otherwise we should be really okay about the way our bond yields have moved, because even when the US moved from almost 100 basis points, we were at the same level.
Do you think today's credit policy in a sense is more like what everybody was anticipating and expecting? There was a tinge of hawkishness, but I guess it is too early for Reserve Bank of India to come out and say that, okay, we won a war against inflation.
No, absolutely. I think I would say not hawkish, not bearish. I would say this was a normal policy where they have taken a normal pause. And from that perspective, of course, at every time he has been highlighting our medium-term target is 4%. Having said that, people may keep on assuming, there was a question in the Q&A also that will you then wait till 4 before you cut? But I don't think they will wait for that. I think at least for the timing, it looks good. Liquidity will come in at some point of time because there is a lot of overhang on government spending. They cannot infuse liquidity and then government starts spending. Then the system will be over surplus on the liquidity. So I think they are managing it a little bit fine-tuned, erring on the tightness side of the liquidity, which is fine. And I think once we see June or something when the US cuts rates, maybe only after that we can expect some rate cut or something. But before that, we can actually ignore any rate cuts or anything coming in. But having said that, bond yields will come off. I think you have a huge demand. I think next year maybe FPI equity and FPI debt will compete with each other to come to India.
Okay. I'm asking this question to some of your peers, which is equity market peers, that in the run-up to the election, where do you see the Nifty moving? So from a bond market standpoint, what has history told us? I mean, is there a pre-election phase which matters, and is there any historical evidence what has happened to bond yield?
So if you really look at it, earlier people used to be always worried about, as in when the election comes in, there'll be fiscal indiscipline and, populist measures and all that. But we have seen with this government in 2019, it didn't happen. And with the state election, the probability of that actually has come down dramatically. So I think this government has been keeping the discipline. And I think 2019 is the only thing which we had. So 2019, they actually didn't go overboard on the subsidies and stuff like populist measures and all that. So this time there is no reason. Of course, people in the back of their mind, they have that, but I don't think there is any reason for people to really look into that. Most of the traders would kind of discount that.
Do you see the bond yields moving from, let's say, December to May? Because there is election. B, the smart money has already started coming back into equity market, and immediately after election, you have the JP Morgan bond inclusion. So there are three things now. First, a floodgate of liquidity which is opening up. Then you have central elections, and then you got the JP Morgan inclusion. Everything is happening in the next 9 months.
So from that perspective, we expect, some people have already started buying. We expect some people to start buying maybe second week of January onwards. I don't think people are going to wait till June inclusion, so there will be enough buying coming in with the new calendar year coming in, starting. So people will start building up that expectation of flows, including foreigners, on the expectation of June inclusion. So I think that money should start pouring in from second half of January.
My final question is that for those who, let's say, bought into US treasuries globally, October and November has been like a dream run. Yields are down, and they are down in a very meaningful manner. Is there a trade in the 10-year paper in the run-up to the election for somebody who, let's say, wants to say, okay, I'm going to take a tactical bet in, let's say, just buying the GSEC in the run-up to the election? Is there merit in thinking on those lines?
Not from a run-up to the election point of view, and anyway, a 10-year benchmark is expensive, right? So, but there are other securities, particularly the one which will get into index value securities, maybe 6 years, 15 years. But that all will start moving once the buying starts coming in second week of January. I think we may see another retracement of 10 basis points, but beyond that, we won't see much retracement there also, because the 10 basis point without any policy action should be good enough for retracement.
Thank you for joining us. And well, this time the camera angle, in a sense, is in sync with what the RBI view right now is. So thank you very much.
Thanks.
With Kunal, I just have to turn here. Right? Kunal, if you're a bull, you need to stay focused, right? I mean, if I say kal thanda tha, aaj dhila hai, it's a very myopic view, right?
Yeah, it's a very myopic view because Nikunj, after 1500 points of rally, 100 point, 100 point की volatility में इतना, I mean, I don't think so. The view should change for the indices, and it's an obvious kind of a volatility because you are at the round strikes for indices.
What is round strike?
21,000 and 47,000 round digit strikes for the indices. So there's bound to be some fight or tussle between bulls and bears at those strikes.
Does it happen round strike? Does it matter?
Yeah, it matters a lot. So even for example, 19,500, if you remember, there was a point where the Nifty stalled at 19,500 mark, and I think it took some 7 or 8 days for the index to climb above those levels. And I think I would probably expect something similar this time around, maybe 1 week of consolidations.
The interesting bit is, before we take a break, is that mid cap has not recovered, small cap has not recovered. So point we were discussing, 10-15% money move back into large caps.
Caps.
Maybe that trade is at play, that playbook is at play.
Exactly, yes.
I think we'll have to wait till next week before we get a decision.
Yes, and such kind of selling is also one of the indications that sector churning has started.
In this case,
small cap
churning.
Yes, market cap
Sector churning. It is a asset classification.
Asset class.
Okay. Appreciate your time. Thank you for joining us. Let's take a break. When we come back, queries and lots of queries. We'll address some individual stock queries with Sanjiv Bhasin. All right, time to just address some queries. Keep them coming, and we'll try and address as many queries as possible. The idea is to really help you take the right decision. We'll use our experience, we'll use we'll use the guidance of our experts. I'll pour in my years and years of market understanding in terms of cycle, and then we'll try and give you the best advice. The first advice is it better to invest in a CPSE ETF or buy public sector stocks based on individual performance? Well, I think CPSE ETF, some would argue and say, is the best play when it comes to the entire basket if you're really betting on PSUs. When it comes to individual stocks, well, you really will have to do a very elaborate hard work, because not all PSUs they go up in a synchronized manner, not all PSUs have the same fundamental, and not all PSUs are part of the CPSE basket. The basket is derived on weightage, and if you're really betting on the PSU turnaround, I would say that basket choice is a much better idea. Let's see if Sanjiv concurs with that. Sanjiv, for someone who's, let's say, saying I'm going to bet on a deep value product in this market, just go for the index. I mean, there's hardly any charge, jhanjat nahi hai, and you get the best everything in 20-30 stocks.
Correct. I fully agree with you. And you can recall, I mean, last 3 years, we actually advocated to buy the CPSE ETF. It was around 15.5. Today it has hit a high of 60. It has been humongous in the returns it has given. So individual stocks have already run up 2, 3, 4 times. If you buy a basket, you will have a spread of all the eggs, and that will give you much more comfort on the volatility. So I definitely advise a CPSE ETF.
The CTA, what do you mind is a good price then to buy CPSE ETF? Because the run-up has been strong. Now the point is, for someone who says, look, I was not convinced then, but I'm convinced now. Can it beat the Nifty? A simple question.
Well, glass half full, half empty. Nikunj, I am expecting now large cap stocks to do much better than the broader index. And that would mean that the index outperformance could come actually from the Nifty or the Bank Nifty. However, I think a SIP in the CPSE, or you can divide all 3 SIPs. Do Bank Bs, do Nifty Bs, and do the CPSE ETF. All 3 will spread your eggs, and you'll have, all 3 indices, which I think will be very good for an investor who has a layman and who's investing with a periodic phase. So a SIP in all the 3 ETFs would be an ideal way to ride the equity cult over the next few years.
The second query is from Rishma John. Would it be reasonable to invest in Tata Motors considering that 53% of ownership of Tata Tech is in Tata Technologies? Sanjiv?
Well, large part of that is already discounted, and that Tata Motors stock is hitting all-time highs because of some of that reason and some parts of the overall buoyancy in EVs and the whole CV cycle. However, I think that better than Tata Tech, TCS would be my top pick. And second, if you want, Tata Elxsi or Tata Communication. A basket of those 3 stocks, because they have got even enough visibility, earnings capacity, and I think the 3 are market leaders in their specific areas.
And also, Sanjiv, for Tata Motors, the sum of part of Tata Tech is not even 50 rupees. It's actually 28 to 35 rupees depending on the brokerage which you track. When the issue was announced, after that the stock has already seen a run up, and ahead of listing it saw a 100 rupee move. So some would say it's already pricing in the birth of Tata Technologies.
Correct. That's why I don't play the cycle now, since it is already run up a lot, and chances of you getting little hurt is more. So I would suggest the 3 large cap TCI Tata stocks on the technology front. If you wanted to play autos, then I think Ashok Leyland is giving you a better entry point at the cost of Tata Motors, given that their bus market is doing exceedingly well, and also their CV cycle, they are actually eating into the market share of Tata Motors.
So, Risham, we've heard advice from Sanjiv in terms of auto and which are the other stocks you should own. And I'm just going to put a thought here before we wrap the show. For Tata Motors, there are 3 large businesses. One is JLR, which is about 70%, more than 70% of the total turnover comes from JLR, the global business. Then there is a truck business, and then there's enterprise value of the entire car business. The car business for Tata Motors has turned around. JLR has turned around, and the CV is something where Sanjiv feels that Ashok Leyland is a better play. So if you're really looking at Tata Tech purely, Tata Motors purely from the prism of Tata Tech, I guess a lot of good news is already in the price, because the stock has gone from 600 to 700 plus, and on the day when Tata Tech went public, the stock actually came down. So Tata Motors, I think, still has a lot of steam left, so to speak, because of the pockets they are in. But for Tata Motors, the moving parts which will move the inertia for this company at that size would be still JLR. It would still be the EV business, and it would still be what's happening to the CV business, rather than a sum of part valuation uptake which would come because of Tata Tech. So Sanjiv, Bhasin, always a pleasure to have you on ET Now. Thank you for joining us. And well, that's it on this edition of Tracking Trends with me, Nikunj Dalmia. It's Friday feeling for the market, but the trend I think is that mid and small cap stocks are sliding and large cap stocks are recovering, led by the bank nifty.